and how our priorities are positioning Kroger for sustained long-term growth. Over the last several months, we've made good progress to position the company for future success. A key part of that success is a strong leadership team. And during the quarter, we continued to upgrade our team. We promoted a top division president to lead our brands, one of our key growth initiatives. We hired a new head of product sourcing who will help us lower our cost of goods sold and close the gap with the industry's best in class. We welcomed a new general counsel, and we continue to elevate strong retail leaders across the company, including several new division presidents. As we continue to build our leadership team, we're also looking at our costs, especially those expenses that don't directly support our priorities or deliver value to our shareholders. As we shared last quarter, we've begun closing approximately 60 unprofitable stores. Last month, we also reduced our corporate administrative team by nearly 1,000 associates. While these decisions are difficult, they're also necessary for the company's long-term success. Additionally, in order to create greater focus and simplify our business, we're reviewing all non-core assets to determine their ongoing contribution and role within the company. And finally, we recently put an issue behind us by reaching a legal settlement with C&S Wholesale Grocers. We are pleased to resolve the claims so that we can remain focused on serving our customers and running great stores. Our efforts to create greater focus are showing up in today's second quarter results. Identical sales without fuel grew 3.4%, which was ahead of our expectations. This is our sixth consecutive quarter of identical sales without fuel improvement. Sales growth was led by pharmacy, e-commerce, and fresh categories. We know that fresh products are important to our customers, specifically in meat and produce. These categories continue to outpace center store sales and reflect the growing demand for healthier options. Our sales growth in fresh categories shows that we're making strong progress in the categories our customers care most about. Improving grocery volume is also important to us. We're making strategic price investments, which led to another quarter of sequential improvement. In fact, since the beginning of the year, we've lowered prices on more than 3,500 incremental products across our stores, which is improving our price spreads against our major competitors. As we lower prices for our customers, we're committed to doing so in a way that keeps our gross margins stable. We're making our promotions simpler and have continued to reduce complex promotional offers. Additionally, we're making it easier for non-digital customers to take advantage of all the value Kroger offers by reintroducing paper coupons in every store. Our customers are recognizing these changes, and they're giving us credit for them. We know this because customer price perception improved in nearly every division this quarter, and we saw another quarter of sequential improvement in share. Beyond the price at the shelf, families are also looking for quality and value. Our brand's products had another strong quarter with sales growth again outpacing national brands. Our brands offer unique products with high quality and represent a point of differentiation for Kroger. Simple Truth and Private Selection brands again led our growth. Looking ahead, we see our brands as a critical strategic asset, helping us grow sales and build loyalty with customers. E-commerce. E-commerce also continues to be an important and growing part of our business. Sales were strong in the second quarter with 16% growth, led by good performance in delivery. We continue to make progress on improving profitability, and we saw improvements in both pickup and delivery profitability on a quarter-over-quarter basis. E-com remains a top priority for us. Running great stores is also critical to our future, and our store teams are delivering on the basics, being in stock, showing clean and uncluttered aisles, and making shopping easier for our customers. Our internal composite scores, which track key metrics like in-stock levels, fresh product quality, and customer service, are showing consistent quarter-over-quarter improvement. And as we're improving our store and e-commerce shopping experiences, we're also taking meaningful steps to reduce our cost structure. In the second quarter, we were pleased with our OG&A rate improvement, and will continue to aggressively look for ways to reduce costs throughout the company. We believe that many cost opportunities remain. So to summarize, we've made strong progress so far this year, and we also know that we have a lot more work to do. Looking ahead, we're focused on investments that will grow our core business. The first of these is new stores. We're on track to deliver 30 major storing projects in 2025, and we're accelerating new store projects with more efficient layouts and faster construction timelines. In 2026, we expect to increase store openings by 30%, helping us grow both in-store and online sales faster. While we are growing our physical footprint, we're also modernizing our business to operate more efficiently and serve customers better. Artificial intelligence is one of the key tools to help us get there. Accelerating our AI efforts is a natural step for Kroger, given our long history of leadership in data and machine learning. Where we've implemented AI in different parts of the organization, we're seeing results with more competitive pricing, shrink improvements, and faster fulfillment, which enables 2-hour pickup for customers. These are just a few examples of what AI is doing to help us better serve our customers, with more and bigger opportunities ahead to both support our associates and improve the customer experience. E-commerce will also continue to have a meaningful and growing impact on our financial results, which is why we announced a thorough strategic review last quarter. We are progressing with 2 key objectives in mind. First, we will improve the customer experience by using our stores to deliver groceries faster. Stores are our most important asset, and when we use our stores to fulfill online orders, the inventory is closer to customers and the last mile delivery costs are lower. As demand for convenience grows, we can leverage our store footprint to reach new customer segments and expand rapid delivery capabilities without significant capital investments. Which leads to our second objective, improving profitability and reducing our cost to serve. We're examining all aspects of our business to drive greater efficiency, including a full site-by-site analysis of our Kroger automated fulfillment network. Where we have seen strong demand in high-density areas, these facilities deliver better results than those facilities where density is lower and customer adoption has been slower. We continue to evaluate all options across all facilities to improve profitability while continuing to provide a great customer experience. We expect to share an update on our strategic review during the third quarter. We're confident that the outcome of our work will lead to both stronger e-com capabilities and a clear path toward profitability. Finally, we're starting the foundational work to refresh our go-to-market strategy. This involves a deep dive into customer data and a rigorous assessment of our competitive positioning. This important work will set us up for even stronger performance in the future. Now I'll turn it over to David, who will review our financial results in more detail. David?
Thank you, Ron, and good morning, everyone. This quarter, Kroger delivered strong results, which reflect continued progress in our core grocery business and robust growth in e-commerce and pharmacy. Momentum in our core grocery business is being driven by improved execution, as well as a disciplined approach to price investments. By reducing the complexity of our promotions and investing more in everyday prices, we are sharpening our price perception with customers and driving volume improvements while responsibly managing our margins. I'll now walk through our financial results for the second quarter. We achieved identical sales without fuel growth of 3.4%. Our sales growth was led by strong pharmacy, e-commerce, and fresh results. We are encouraged by the continued improvement in grocery volumes, particularly in the perimeter of the store. Food inflation was slightly lower in the second quarter compared to the first quarter, but continues to trend in line with our original expectations from the beginning of the year. Our pharmacy business delivered another strong quarter, driven by core pharmacy scripts and growth in GLP-1s. Although strong growth in pharmacy sales impacts our margin rate, it drives positive gross profit dollar growth and improves our overall operating profit. This quarter, we've been pleased to welcome more ESI customers back into our stores. We continue to expect that the full return of the business will take time, and in Q2, ESI had a roughly 15 basis point positive impact on our ID sales. We continue to keep a close watch on the changing tariff environment. As a domestic food retailer, we expect a smaller impact than some of our competitors. We continue to be proactive to address exposure where we do have it, and our approach remains to raise prices as a last resort to ensure that we keep prices as low as possible for our customers. Tariffs have not had a material impact on our business thus far, and as of now, do not expect them to going forward. Our FIFO gross margin rate, excluding rent, depreciation and amortization, fuel, and adjustment items, increased 39 basis points in the second quarter compared to the same period last year. The improvement in rate was primarily attributable to the sale of Kroger Specialty Pharmacy, lower supply chain costs, and lower shrink, partially offset by the mix effect from growth in pharmacy sales, which has lower margins and price investments. After excluding the effect from the sale of Kroger Specialty Pharmacy, our FIFO gross margin rate decreased 9 basis points, largely in line with our expectations to remain margin neutral. The slight reduction in our FIFO gross margin rate was primarily due to pharmacy mix, with good progress on rate in the rest of the business. We have many levers to improve our gross margin rate over time, and we will continue to use those to balance incremental price investments that improve our value perception with customers. We expect our gross margin rate for the full year on an underlying basis to be relatively flat as we balance the impact of pharmacy mix, margin enhancement initiatives, and price investments. The operating, general, and administrative rate, excluding fuel and adjustment items, decreased 5 basis points in the second quarter compared to the same period last year. The decrease in rate was primarily attributable to improved productivity and a favorable comparison to prior year, which included certain non-recurring charges, partially offset by the sale of Kroger Specialty Pharmacy. After adjusting for the effect from the sale of Kroger Specialty Pharmacy, our adjusted OG&A rate significantly improved, decreasing 41 basis points on an underlying basis. Cost optimization is one of our top priorities, and driving productivity has long been a core competency of this company. We will continue to build on that strong track record by identifying new and innovative ways to deliver cost savings across our business, and our teams are actively pursuing opportunities across multiple areas. One of the areas we're prioritizing is sourcing. We see significant opportunities to optimize our costs across both costs of goods sold and goods not for resale. We also have a significant and continuing opportunity to modernize work across the enterprise, making us more agile and efficient and leading to a more streamlined operating model going forward. Our adjusted FIFO operating profit in the quarter was $1.1 billion. Adjusted EPS was $1.04, reflecting 12% growth compared to last year and our strongest growth rate since the fourth quarter of 2023. Fuel is an important part of Kroger's strategy and offers an additional way to build loyalty with customers through the fuel rewards in our Kroger Plus program. Fuel sales were lower this quarter compared to last year, attributable to a decrease in the average retail price per gallon and fewer gallons sold. Fuel profitability was also behind the same period last year, and we expect gallons sold to remain lower on a year-over-year basis for the remainder of 2025. Our e-commerce business delivered 16% growth this quarter, driven by an increase in both households and order frequency. This growth was led by delivery, with orders fulfilled from both our stores and centralized fulfillment centers. We are seeing a clear trend of customers opting for faster delivery times, an area where we are well positioned based on our conveniently located store network, coupled with our delivery partner, Instacart. Today, we can offer delivery in under 2 hours from 97% of our stores. This capability is resonating with our customers, and we continue to see more orders placed in these short windows. This digital momentum directly fuels our retail media business, which had a strong quarter and is a key contributor to profitability. While we're encouraged by the performance in the quarter, we believe we have an opportunity to meaningfully accelerate our growth. To support this, we're actively reviewing the operating model and how we engage with retail media clients to ensure we are strategically positioned to maximize growth in this area of our business. I'd like to take a moment to provide a brief update on associate and labor relations. We made significant progress on agreements this quarter, which provides certainty for our associates and our business. In total, we ratified new labor agreements covering approximately 54,000 associates. We continue to meaningfully improve wages and benefits, and we value our strong working relationships with our unions. By working together, we're better able to support associates and improve the experience we provide customers. These collective efforts have helped us build a more stable workforce with improved retention rates, which in turn drives a better customer experience. I'd now like to turn to capital allocation and financial strategy. Kroger delivered strong adjusted free cash flow this quarter, which reflects the strength of our operating performance. Free cash flow is important to our model, providing liquidity for our operations and strengthening our balance sheet. At quarter end, our net total debt to adjusted EBITDA ratio was 1.63, which is below our target ratio range of 2.3 to 2.5. This provides us with significant financial flexibility to pursue growth investments and other opportunities to enhance shareholder value. We expect to return to our target leverage ratio over time. Our capital allocation priorities remain consistent and are designed to deliver total shareholder return of 8 to 11% over time. We are focused on investing in projects that will maximize return on invested capital over time, while remaining committed to maintaining our current investment grade rating, growing our dividend subject to board approval, and returning excess capital to shareholders. In the second quarter, we raised our quarterly dividend by 9%, reflecting the strength of our free cash flow and our commitment to returning capital to shareholders. Our quarterly dividend has grown at a compounded annual growth rate of 13% since its reinstatement in 2006, and this marked the 19th consecutive year of dividend increases. Dividend increases are just one component of our broader total shareholder return strategy, and we plan to continue returning capital to shareholders through share repurchases. We expect our $5 billion ASR program to be completed in the third fiscal quarter of 2025. The ASR is being completed under Kroger's $7.5 billion share repurchase authorization. After completion of the ASR program, we expect to resume open market share repurchases under the remaining $2.5 billion authorization. We expect to complete these open market share repurchases by the end of the fiscal year, which is contemplated in full year guidance. A key priority for Kroger is to improve ROIC, which includes reallocating capital towards higher return projects such as new storing. We are pleased with the progress we are making on these projects and are on track to complete 30 this year. As Ron mentioned earlier, we plan to accelerate these storing projects beyond 2025 and expect them to be an increasing contributor to our growth, with a 30% increase expected in 2026, positioning us for sustained expansion and market share growth. I would now like to provide some additional detail on our outlook for the rest of the year. We are pleased with our second quarter results, which reflect continued momentum in our business. Sales have been strong, led by e-commerce, pharmacy, and fresh, and we are encouraged by the improvement in grocery volumes. As a result, we are raising our identical sales without fuel guidance to a new range of 2.7% to 3.4%. For Q3, we expect identical sales without fuel to be slightly below the midpoint of our full year range. We are also raising the lower end of our adjusted FIFO net operating profit and net earnings per diluted share guidance to new ranges of $4.8 to $4.9 billion and $4.70 to $4.80 respectively. I will now turn the call back to Ron.
Thanks, David. The team continues to make progress in running great stores. We are more focused on our core business and our customers. We're moving with speed and we're simplifying the company. We are executing better in our stores and we are seeing it in the results, both our quarterly financial results and our customer metrics. Our customers are telling us they like lower prices and simpler promotions. They care about quality and value, and they appreciate better store conditions and better service. Our work is far from finished, but I'm proud of the team and the progress they're making. Before we move into Q&A, I'd like to comment briefly on the CEO search. There's no specific news to share at this time, but the board remains actively engaged in the process. We'll now open it up for questions.
Thank you. As a reminder, if you'd like to ask a question, that's star followed by 1 on your telephone keypad. And if you'd like to remove your question, that's star followed by 2.
All right, everybody, we are listening. We just listened to the earnings call for Kroger. And what I thought I could do now is share with you my analysis on Kroger that I updated today, this morning when I got their earnings information. And boy, I like it when a plan comes together. I bought shares this morning. I saw that their financial data was excellent. And what I appreciate about Kroger is they are so darn consistent, predictable, well operated. They do what they said they were going to do. They bought back shares. I don't really care about dividends. These guys pay a dividend. Some people do, so that's good. And overall, I think Kroger is an excellent run company. I bought shares like down here this morning. I'm not a day trader, but I like making a decision on a stock after earnings, looking at their financials, and then buying shares. It's nice to get a little bump on the shares I bought. This is a $45 billion market cap company, and the revenue, it isn't showing up, but I'll show it in a little bit. PE ratio is quite rational at 18 and 13. Looks like, Dwayne, you've been trying to get into this stock. And, I'm going to show you my valuation. And again, I bought shares this morning. There's a couple ways you enter into a stock. One of them being, you buy a big portion of shares at one time. Can't argue with that. Some people do that. I don't. I dollar cost average because at times I find these great businesses and I'm trying to be patient and buy when the buying is good. And I'll show you my valuation and I'll share with you what I'm doing. Thanks for tuning in, by the way. And LACPA, is it a buy or sell? I'm going to answer that question. Thanks for tuning in. I think it's the first time you've commented on the live stream. Thank you, sir. Okay, so we have a company with rational PEs. Analysts think it's discounted a little bit. Year to date, this thing's 10.5, and you're getting paid that almost 2% dividend. So you're not breaking any records, but you're keeping up with the S&P. That's not a bad thing. That's a good thing. With a very low risk stock, right? Why do I think it's low risk? These guys are a retailer of groceries. We're not going to stop eating. We're not going to stop breathing. We're not going to stop eating, and we're going to need water. Okay. And there's some fundamental like products and services we need. Groceries is one of them. That's one. One of the reasons I own the stock is this one's kind of not a lot of thought needs to go into it. I just need a very well operated food company, and this is the one. I've owned it for a number of years and glad that I own it. And we know what they do. We know exactly what they do. I also own Instacart, which is a delivery of groceries, but it's more of an e-commerce play where you go online, order your groceries, and one of your Instacart, I don't know what they call them, right? Not like an Uber driver. It's a Instacart delivery guy or gal. they go to a Kroger, pick up the groceries, and then bring them to your home. I think Kroger is trying to get more organized, optimized to work with the Instacarts and all the other food delivery apps so that they can increase their volumes that way. That'd be great. So that looks good. It's a very stable stock. Let's look at the 5-year. So this is why I own Kroger. 93%, 2% dividend, right? So 5 years at, I guess, let's call it 9 points. We're at 102% for a low risk stock. Thank you very much, stock market. I'll buy some more. And the stock has had a very nice rise over 5 years. It's had moments when, or I should say, periods of time when accumulating shares was a good idea. I'm glad I did that. It has had a really nice upward trajectory, but you see that it's had a pretty good little pullback here recently. So again, I'll get to my valuation in a few minutes and tell you what I'm doing. Consistency, right? This is a big business. For a fiscal year, they end their fiscal year a month after the calendar year closes. That's the retail calendar that a lot of these retailers follow. And it's a big business and they grow a little bit. But you saw in the earnings report that they're growing better than that. They're growing at over 3%. And that's substantial for a grocer at 150 billion. 3% adds up to $4.5 billion. That's a pretty good chunk of revenue added to the top line. So that looks good. And they are consistent in their profit, earnings per share, growing it. And the share buybacks, super impressed. And I put it on the chat that they went from, let me show that again. They were at 723 million shares outstanding, and they're down to 662. That's like pretty good chunk. That's like 8% of the share count. It's very good. So I'm going to have to reduce that on my valuation. I haven't done that. So my valuation of the stock, here it is. Here's the share count. That's got to change. And guess what happens to the value of the remaining shares? Yeah, they went up. They went up from 28% based on free cash flow to 34. That's what share counts do. Now the stock is discounted by 31% as I speak, based on the most current stock price. I bought shares about 40 minutes ago and maybe 45 minutes ago. Glad I did so. I'm going to buy shares for maybe another $10,000 of shares. I own roughly about $60,000 of Kroger, and I'd be happy increasing that to putting capital about having about $70,000 in Kroger. The company is super consistent. A couple of things that I'll note. You guys are familiar with my valuation model. I'm starting to use a discount rate of 7.5 on really low risk companies because interest rates are falling. The economic news today is more, I think, push for the Fed to lower interest rates. The 10-year is pretty much at 4% and it's dropping. We're probably going to see a 10-year at 3.75 in the next 6 months or so. That just lowers discount rate on all companies. And I'm going to begin to go 7.5 on really low risk companies. And Kroger is one of those. Again, we're dealing with groceries. It's not like next year everybody's going to decide, you know what? Let's think of the iPhone. Maybe next year everybody thinks iPhone isn't cool anymore, or I don't want to use a phone anymore. That's not going to happen. Instead, we're going to see, with Kroger, groceries will never go out of style. They'll just keep buying at Kroger. So, and the pharmacy sales were good. All those things were good. Low risk business, 7.5 discount rate. The way they guide for cash flow, these guys are so reliable. And their reliability is, when a company's consistent, dependable, reliable, it kind of makes me comfortable to be an investor. And I feel like Kroger, I've said this before about the company, they're in good partnership with their owners. Their owners are me, stockholders, you, stockholders. We're the owners. And sometimes businesses, companies are not in very good partnership. They blindside surprise investors like Intel did, and their stock gets destroyed. It should. Kroger is the opposite of that. They're in very good partnership. The way they communicate to us is like owners. We're doing things that are good for you, reducing share counts. When we tell you this is going to be the cash flow, it's going to be the cash flow. The way they guided last quarter is exactly the numbers they're coming in at. The way they're guiding is very consistent. So I really, when I put this forecast together, this is one of the better forecasts that I'm going to be able to go a year forward, come back and say that was pretty close. That was on the money. So cash flow forecast looks good based on cash flows, adding cash, taking away debt. The business has a value of $67.8 billion of net present value if we look at the cash flows. And then when we compare it to market cap, this stock is discounted by 34%. It's a really nice discount on a very trustworthy business. And when you think about what's been going on, obviously, like yesterday, you had some stocks go up 35%. And I mean, we've had some technology, AI stocks just flying up. Well, investors forget about groceries. They can take it for granted. Oh man, groceries, don't want to be an investor. But I don't take it for granted. I like buying stocks when nobody likes them, nobody's paying attention. And Kroger, I think, is in that category. I updated my earnings per share valuation using the earnings per share for the year that's coming, which is $5.46. A very nice expansion, by the way. PE of 16, their growth rate is good. And that earnings per share, I'm going to be conservative and say they're just going to grow a little bit. So 23% discount if I use their earnings per share intrinsic value. So 31%, I am a buyer of Kroger. I think a few of you are asking what I'm doing with the stock, and there's your answer. So Kroger is just a solid business. And I see your comment, Mitch, and I'm going to get to that comment. We're going to look at that company. Give me a few minutes just to finish things off on Kroger. Now, this is what analysts were saying before the earnings call. I am surprised that, some analysts are the dispersion of price targets is kind of wide on this company. Because again, this is one of the most reliable businesses that I get to follow. And rarely do they surprise. But, this analyst will have their opinion. When we look at what these analysts are saying, some of them are saying strong buy, and a total of 8 holds. As soon as we see a sell-off, this stock will become super popular, by the way. That's another reason why I like holding some stocks that, when everything else starts going down, because it will at some point, we'll have a sell-off. I don't know when. Let's just enjoy the rally while it lasts. Great. Let's keep making money. Nothing against that. There's no rule against making lots of money. But these guys are going to be consistent, growing year after year. So that looks really good. Profits are going to expand. I like what they're doing in the pharmacy. Looks like they're putting more pharmacies in location. That's a very good idea. That way they get the foot traffic again. Hey, I'm going to go get that prescription. Oh, by the way, while I'm there, I'm going to pick up some groceries. I'm going to pick up some vegetables that we need, some milk, eggs, all that good stuff. So that's really smart, as well as the fuel sales. So that looks good. We went over their balance sheet. Their dividend is solid. They have plenty of cash. Again, their buybacks is very, very good. I think Warren Buffett will give him a thumbs up. I don't know if he uses that gesture, but if he did, he'd give him a thumbs up. So that's Kroger, guys. Thanks so much for tuning into the earnings. Now we're going to turn our attention to a member request. Mitch wants to look at KSPI. I don't know what KSPI is. Are they a grocery company? Just kidding. KSPI. So a joint stock company together with its subsidiaries provides payments, marketplace, fintech solutions for consumers, merchants in Kazakhstan, Azerbaijan, and Ukraine. It operates 3 segments: payments, marketplace, fintech. How interesting. All right, let's take a peek at their website. I'd like to get to know them a little bit, and then we can start looking at their numbers. All right, so e-commerce. I like e-commerce and fintech. Okay. So I know what payments are, fintech. What's the story with their marketplace? So, okay. So this is an experience. This is an example of what you would be buying, and it's probably regionally optimized for those countries they named: Azerbaijan, Ukraine, and the other country, I forgot that name. That looks good. Let's go back. So this is a good idea. I like e-commerce. This is in US dollar, $16 billion market cap. Revenues are $6 billion. P ratio is really low, 7.8. Interesting. They paid dividend. All right. Year to date down. 1 year down. 5 year down. Okay. Or how long have they been public? They haven't been public for 5 years. They've been public for, I think, a little over a year. It went public January 19th, 2024. So I guess a year and a half. Okay. So they've been selling off. Let's take a look at their financials. So this is in this currency, KZT. What is KZT to US dollar? So it's a fraction of a cent. Okay. And based on the rates of growth, it looks like they're growing really well. And actually, their growth in Q2 really accelerated nicely. That looks really good. So one thing first is, it looks like, Mitch, you've got some good intel here. They're basically a super app, like a WeChat in China. Okay. Very good. Sounds good. And we're looking at KSPI, a member request, taking a look, seeing what this business is all about. The last quarter, this growth looks really good. That means they're accelerating their growth. And that looks impressive on the percentage of growth. Now let's see how profitable they are and what kind of free cash flow they're generating. So their gross margins are very healthy, very high. I think what they're doing is they have the platform. They don't carry any inventory. In essence, they're just getting the traffic and then getting that traffic to get in a buying pattern that they then work with one of their partners, somebody who wants to sell on their platform. It's similar to what Amazon does. So, and like WeChat and other sites, it's pretty lucrative if you can make it work. And based on their growth rate, it's pretty impressive. You look at their overall profit margins of 34, that's really good. Free cash flow margin, 21%, very, very good. So I'm using the adjectives that I got to be careful. I should say I'm careful in using those adjectives because I do use them when I'm impressed. And in this case, I'm at this point impressed. 3 analysts cover this stock. The best price target is 140. The worst one is 96. So collectively, they think it's discounted. Let's look at their forecast. We've got 9 analysts weighing in on the forecast for this year and next year, and then 7 for the year that follows. And they're going to keep growing nicely. This is a good growth rate. Based on the profit that they are making, this is a very desirable business because they grow at 20% and they have profit that's way up there at 30%. That's a really, really valuable combination. So very good. One more comment from Mitch. Looks like Mitch has been doing some homework on this. Very good. I think cash flow profits are down because they're trying to expand into Turkey and recently completed an acquisition. Okay. But I think their profits and cash flow look okay. I think that's what caused the growth rate, that acquisition and the expansion is what created that bump in their revenue. Okay, so I'm liking what I'm seeing. It's in a region that I'm not currently invested in. I started investing in a Polish company that does more of the supply chain for e-commerce in providing lockers in post. I've got a tiny investment in that company. So let's keep looking here. So what I like about stock analysis is that they convert for a US investor. And I don't know if they did that on this one. I'm going to double check. So this is in US dollar, correct? Okay, good. So they convert the values into US dollars. So I wanted to see their total revenue in US dollars and some other factors. So their revenue is 6 billion. So that's a pretty good sized business. It's a big small cap, larger small cap. And they have earnings per share of $10.97. Let me note that. $10.97. And I'm going to note a couple figures and we'll do a quick valuation on this one. Okay, so we've got cash on the balance sheet of 2.12 billion and debt of $1.080 billion. That looks good. Free cash flow. They're free cash flowing at $1.2 billion of free cash flow. All right. And what are their shares outstanding? Shares outstanding, 190 million shares outstanding. Okay, so we've got that. Now let's go pop over to my model and take a look at the value of this guy. Okay, so got that done. Let's compare this company with Mercado Libre. So Mercado Libre is similar. They actually do fintech as well. They're just trying to focus on the Latin American region. And this company is focused in the countries named. And their name is Joint Stock. So I guess they're calling themselves Joint Stock because it's not their stock, it's their customers. So that makes sense to name the company that. And, I did that a little too soon. All right, so put that there. So we are going to do a valuation. We're going to value this stock that just came up. Mitch brought it up based on their cash flow forecast and then also their earnings per share forecast. So okay, so this, like Mercado Libre, I use a higher discount rate because I'm in the US and I'm taking a risk investing in a company that's way on the other side of the world. So like this stock here, and I'm less familiar with these countries, so I'm going to go to an 11. This is my decision process. All right, free cash flow. We're going to use trailing 12 months plus growth. They are growing really well. The forecast, and the reason I study this forecast, just to kind of bring you into my processes, the reason I like to look at what analysts are thinking the growth is going to be is that you don't want to look backwards and say, oh, what have they been growing over the past? I'm going to use that as my number to predict the future. No, why don't you let analysts say, hey, I've studied the company and consensus is they're going to grow at, let's say, 20%. So I'm going to use that as a growth rate on cash flow, as well as down here, they give us a rate of growth for earnings per share. So I can use those numbers in my valuation. So we'll go with 20% up here. All right. So trailing 12 months plus growth, their trailing 12 months of free cash flow is a good $1,230,000,000. We're going to add 20% to that. Beautiful. Okay. So we have an intrinsic value of $32 billion for all that cash flow we expect in the future. I'm going to add all the cash that's on the balance sheet. That is a typing error. And then we're going to take away the debt that is on the balance sheet. So it adjusts the equity value of the company. Shares outstanding are 190.78. And we have a nice discount, compelling 51% discount if I take the net present value of all those cash flows discounted by 11%. That's a pretty good looking discount. Earnings per share. What is that earnings per share number? It's $10.97. This is a growth business, but it's out of my home country. So I'm going to keep a nice conservative expectation there. It still drives a really nice discount. Now, this makes sense, right? It's, U.S. companies tend to drive really high prices, and it's what a lot of investors want. Hey, it's in the U.S. We know the reporting standards and all that good stuff. And when you go international, you get discounted companies. And this is a very compelling discount, 61%. And in a way, it helps me diversify. I'm happy to be an investor in the U.S., happy to buy U.S.-based companies, but this gives me an opportunity to invest on the other side of the world. The other side of the world also wants to buy e-commerce. They also want to use e-commerce. So this is a really good idea. So Mitch, I like everything I'm seeing, sir. What do you think? So good one there on this little business, joint stock company. I like what I'm seeing. Good stock. Let me make sure that I'm going to watch this stock. I'll put it on my watch list. Keep an eye on it. I might buy some shares, man, because I like diversifying in e-commerce. E-commerce has been a good category for me. I own Amazon, Alibaba, Mercado Libre, and Alibaba in particular has been going up really, really, really well. I'm really glad for that because that makes sense. If you think about, in China, they need e-commerce. They need the things that Alibaba produces. Well, here's another opportunity to maybe look at joint stock and begin to participate in the economy that they have in the Ukraine and Azerbaijan and Turkey. And was it Kazakhstan was the other country that they were in? So I like that whole idea. I'm good with this business, the type of business. I like the business, and really good idea. Thank you for bringing it up. Hopefully you found my analysis interesting, Mitch. All right, so let's see. So Mitch, got a little starter position. Very good. Yeah, I think I might do that as well. So good luck to you. And if I buy the shares, good luck to me. And it's interesting they pay a little dividend. They have the cash to do that. It might be that these companies are looking to attract investors and have credibility. It's a good idea. American companies, they don't have to do that. They just have to grow. And let me tell you, if you keep growing at these rates, you don't have to pay me any dividend. You just keep growing. You keep getting bigger. You keep getting more profitable. Your job is to grow. Your job is to obsess on the customer and make your platform the best platform in that region to go buy online. You do that part, the stock will take care of itself. So that is Joint Stock Company. And I thought I'd put together a quick little live stream. We went over Kroger, and just to give a summary to maybe those that joined a little late, we've gone over two stocks here. We listened to the Kroger's earnings call. I noted in the chat, my comments around Kroger. So we really dissected Kroger. We looked at the value of Kroger and the fundamentals. The stock is up 1.5. Excellent. And this is a consistent stock. This is not going to be as glamorous as Broadcom, NVIDIA. And of course, we'd rather be in those stocks. You should go after growth stocks. But maybe for older investors like myself that, hey, I'd like to have a couple of stocks that when everything else is doing horribly, these are going to really stand up tall. You get a nice recession going, this stock is going to be like the outperformer stock. It's going to be killing all the other stocks. Like, hey, look at me. I'm up 25% while all these other stocks are down 50%. That's what Kroger will do in down years. So, and overall, a rate of return of more than 100% because you add that dividend, you're doubling your money over 5 years. That's a really nice investing idea for maybe an older investor or an investor that doesn't want the big swings of technology. That is Kroger, and it is discounted. I run the free cash flow analysis. I did change a couple of things. I'm bringing down my discount rate to 7.5 on very low risk businesses. And it's a discount of 30% on a very predictable, safe stock. And the second stock we looked at was this Joint Stock Company, brought up by a member, Mitch. I think Mitch is in Europe. And this has a really compelling discount, 61%. It's been growing really well. And I took their cash trailing 12 months, grew it by 20% in the first 4 years. Then we'll grow at 5%. I expect that's going to be a good growth rate because they're in a very organic, fertile market in a region that probably is, they're probably getting organic grown new users of e-commerce in those regions that are like, great, yeah, I can buy, at a better price online. I can get more information online. All those things are very good. And this stock has got a nice discount to it. It's also a good investing idea, diversifying around the world. Some investors don't like the idea. I respect it. I'm so invested in the US, I'm good with that, but I also like to diversify around the world because I recognize other parts of the world are growing a little faster. Their GDP is growing faster, or those markets haven't had e-commerce for the 2 decades we've had it, actually coming up on 3 decades. So here in the US, it's like everybody uses Amazon. Everybody's been using Amazon for a long time, but you go to other regions and they're like, hey, they just started using it in the last 5-10 years. There's a lot of growth to be had there. That's what is interesting to me. And this stock does look really, really interesting. I'm going to think about it, organize my thoughts. And what's interesting is the market hasn't woken up to this stock. I'm okay with that. Alibaba was similar, Alibaba was not being recognized by the market. The market was like, I don't know if we like Alibaba, it's way over in China, but it was just getting things done for itself. And now the market's paying attention. Hey, Alibaba, of course, let's go buy that stock. But for a long time, this stock was depressed. It was way down here. Okay. And, the likes of like Charlie Munger were very high on this stock. Believe that it was like in a different way, but similar. It was like the Costco of China. And this stock has really been a big performer in my portfolio. I bought at good levels, good prices, and I've got a big bet on Alibaba, and I'm glad I did so. So this theme has worked. Mercado Libre is also an investment that I have. And Mercado Libre has also performed really well. And it's a similar company. And of course, we've got Amazon, the big behemoth, the gigantic, awesome company. And let's go with KSPI in there. And you see that KSPI for the 5 year, it's doing okay at 57. But for the 1 year, KSPA is the oddball. It's down while everything else is up. And in some cases, up a lot. So, hey, these guys are performing well. Their financials tell me that they're doing well as a business. So I think opportunity is knocking on my door saying, hey, take a look at this company. It may be a good one to have. Thanks for bringing it up, Mitch. All right, guys, let's end it there. If you guys like this format where we do some earnings calls, please let me know. If you think otherwise, please let me know. I don't want to do live streams that you guys don't like. But judging from how many people are on, I think people were a little interested in Kroger. And we got a bonus of looking at joint stock as well. I'm going to end it there. You guys have a terrific day. I hope the markets treat you well. It's a lot of green out there. So I think chances are your stocks are up. Looks like all the big boys are kind of taking the day off. They went fishing together. They're out there at a lake fishing. They got their line in the water. And all these hardworking companies are really making it happen. So hopefully you own all these stocks and you're having a great day. All right, guys. Thanks so much for watching. Have a terrific day. I will talk to you soon.